Here's something that shocked me when I started researching this. Most financial experts don't recommend having just 1 or 2 bank accounts. They recommend having 4, sometimes 5, and before you think that's crazy, let me show you why this simple strategy is one of the most powerful tools you have to prevent overspending, protect your emergency fund, and actually reach your financial goals. I'm going to break down exactly which accounts you need, what each one does, and how this transforms your relationship with money. Stay with me. Let's start with why most people struggle with money even when they're making decent income. I used to keep everything in one checking account. Paycheck comes in, bills go out, groceries get bought, Netflix gets paid, and whatever's left at the end of the month, that was supposed to be my savings, except there was never anything left. I'd look at my balance, see a comfortable number, and think I can afford that. Then rent would hit, my car insurance would auto-debit, and suddenly I'd be scrambling. This is called mental accounting failure. According to research published in Behavioral Economics, when all your money sits in one account, your brain treats it as one big pool available for anything. You lose track of what's already spoken for. You overspend without realizing it because there is no psychological barrier between your rent money and your entertainment budget. Money coach and certified financial planner Ohan Kahit recommends households maintain 4 accounts, one checking for monthly recurring bills, another for variable expenses, plus one savings for emergency funds, and a second for other savings goals. 4 accounts, not 1, not 2, 4 minimum. And here's why this matters more than you think. When you split funds into multiple accounts, it prevents you from overspending because once your discretionary spending account is low, you know it's time to cut back until your next payday. The psychology is simple but powerful. When you see $3,000 in your checking account, your brain doesn't automatically subtract the $1,200 rent due next week, the $400 in car expenses, or the $300 in subscriptions. But when you have separate accounts, when your bills account has exactly what you need for bills, and your spending account has exactly your budgeted spending money, you can't accidentally spend your rent on dinner with friends. The physical separation creates a mental boundary that protects you from yourself. This is the foundation. But the accounts serve different purposes, and understanding those purposes changes everything. Let me walk you through the expert-recommended structure. This comes from what is called the high-five banking method, strategy developed by financial experts specifically to make budgeting effortless. This is your non-negotiables account: rent or mortgage, car payment, insurance, utilities, subscriptions. This account is for mandatory expenses, which typically take up a large percentage of your income, but not paying them can quickly affect your life and your credit score. Calculate your total monthly fixed expenses. Let's say it's $2,500. That's what goes into this account every month. Nothing more, nothing less. This money is untouchable for anything else. The beauty of this system: you never have to worry about whether you can afford to go out to dinner. That money isn't in this account. It can't be spent on dinner because it's already allocated. This is your discretionary account. Groceries, gas, coffee, entertainment, shopping. Transfer a set amount of money into the account each payday to cover whatever brings you joy, and once the account reaches zero, stop your spending until your next deposit. Let's say you budget $800 per month for variable spending. That's roughly $200 per week. When Friday night comes around and you want to grab drinks with friends, you check this account. If there's money, great. If it's running low, you know you need to be careful. This is where the magic happens. Because this account is visible and limited, it creates natural spending awareness. You're not relying on willpower, you're relying on a system. This is your financial safety net. Most experts recommend keeping at least 3 to 6 months worth of living expenses in this account. Here's what most people get wrong. They keep their emergency fund mixed with their regular savings. Then when they want to book a vacation or buy something nice, they borrow from the emergency fund and tell themselves they'll pay it back. They never do. Your emergency fund needs to be completely separate. Different account, maybe even different bank. This money exists for one purpose: genuine emergencies, job loss, medical bills, major car repairs, unexpected housing costs. Separating your emergency fund from a sinking fund is wise because otherwise it is tempting to dip into your emergency fund for things that are truly emergencies. This is where people's eyes light up because this is the account that makes big dreams achievable. A sinking fund focuses on one specific savings goal, helping you avoid developing a reliance on credit when you want to make a purchase but can't currently afford it. Want to take a vacation in 8 months? Calculate the cost, let's say $3,200. Divide by 8 months. That's $400 per month going into your vacation fund. When August rolls around, your trip is paid for. No credit card debt. No stress. Same strategy works for anything. Down payment on a car, new furniture, holiday shopping, wedding attendance, home repairs. You're not scrambling when these expenses hit. You've been preparing. If your annual property tax bill is $4,800 due each December, you set aside $400 monthly starting in January. By December, it's there waiting. Stress-free. Now, let's talk about why this system works. When budgeting apps and willpower fail, there's a concept in behavioral economics called mental accounting. Mental accounting describes how individuals categorize, evaluate, and manage money in different mental accounts rather than treating all money as fungible. Your brain naturally wants to put money into categories. The problem is, when everything lives in one account, those mental categories collapse. Your brain can't maintain the separation, but when you physically separate the money, the mental categories become real. They're reinforced every time you log into your bank. Your rent money looks like rent money because it's in the rent account. Your fun money looks like fun money because it's in the fun account. This taps into something psychologists call decision friction. Adding small inconveniences gives your brain a moment to assess whether a purchase is worth it. When you have to think, wait, which account am I pulling this from? It creates a pause. And in that pause, you make better decisions. You might realize you're about to spend grocery money on takeout, or you're about to dip into your car fund for concert tickets. That friction isn't a bug. It's a feature. It's what prevents the impulsive, emotional spending that destroys budgets. Once you've got your 4 core accounts set up, this is where it gets really powerful. Multiple sinking funds. Creating a sinking fund may make it easier to save for major goals or purchases and plan ahead for future purchases. I'll give you a real example. Let's say you have these upcoming expenses over the next year. Holiday shopping in December, $1,200 car insurance annual premium in July, $1,400 summer vacation in June, $2,500 emergency, home repairs estimated, $2,000. If you wait until these expenses arrive, you're going to panic. You're going to put them on a credit card. You're going to raid your emergency fund and never replenish it. But if you set up sinking funds, holiday fund, save $100 month for 12 months car insurance fund, save $117 month for 12 months vacation fund, save $209 month for 12 months home repair fund, save $167 month for 12 months total, $593 per month being allocated to future known expenses. December, your holiday shopping is covered. Come July, insurance payment already there. Come June, you're booking flights with cash you've been setting aside for months. The main advantage of a sinking fund is that it helps you avoid developing a reliance on credit and creates positive financial habits. Some banks let you create multiple sub-accounts within one savings account. Others require separate accounts. Either way works. The key is the psychological separation. Let me tie this all together with the biggest benefit: overspending prevention. Designating accounts for different spending categories helps you avoid overspending by ensuring you don't have to worry about bouncing a rent check because you spend too much on groceries. Think about how most people discover they're in trouble. They check their account balance after a weekend of spending and realize they don't have enough for next week's bills. Then comes the scramble, the stress, the overdraft fees, the credit card swipe to cover the gap. With purpose-based accounts, that doesn't happen. Your bills account is protected. Your emergency fund is untouched. Your sinking funds are growing on schedule. The only account that can go to zero is your variable spending account. And that's okay. That's actually the point. When it hits zero, you stop spending. You eat what's in your pantry. You skip the coffee shop. You wait for your next paycheck deposit. No shame, no guilt, just boundaries. The system removes the daily mental load of tracking every dollar and constantly asking yourself, can I afford this? You can afford it if the money's in the right account. If it's not, you can't. So how many bank accounts should you have? According to financial experts, minimum for bills, variable spending, emergency fund, and sinking funds. But honestly, 5 or 6 is better once you start breaking out multiple sinking funds for different goals. I know this sounds like more work, more accounts to manage, more transfers to set up, more logins to remember, but here's the truth. It's actually less work because you're not constantly doing mental math. You're not tracking transactions across one overloaded account. You're not stressing about whether you can afford something. The system does the heavy lifting for you. Set up automatic transfers on payday. Your paycheck hits, and the money immediately flows into the right accounts. Bills account gets its allocation. Spending account gets its budget. Emergency fund gets its contribution. Sinking funds get their monthly deposits. Then you live your life. When you want to spend money, you check the spending account. When a bill is due, the money's already there. When an expense you've been planning for arrives, you've got a fund waiting for it. This isn't about restriction, it's about clarity. It's about knowing exactly where you stand with your money at any moment without doing calculations or feeling anxious. If you found this breakdown helpful, do me a favor and hit that subscribe button. We're breaking down the real strategies that make personal finance work, not the theory, but the actual systems people use to take control of their money. Because at the end of the day, financial success isn't about how much you make. It's about how intentionally you manage what you have. See you in the next one.